Thank you everyone for connecting for today's call. We really appreciate your time and we welcome everyone. First of all, good morning to all our participants from US and Canada geographies. Good afternoon to everyone, those who have logged in from Europe and other continents, and good evening to entire Asian Pacific clients. Today's call is all about how the quantitative strategies AQUA has played in last 18 months, what kind of processes we have implemented, how we have been amongst the good performing strategies in a trending market, and protected the well during the fall of the market. Uh, the detailed explanation about the strategy, about processes, about the systems will be taken care by my colleague Siddharth, who's part of this call today. Before that, I would like to just touch upon the few very key important aspects which are very important for every investors and partners to know. Prabhudas Leeladhar Portfolio Management Services has been now a standalone entity in PL Asset Management. All of you must have received an email communication from my team stating that we have now started a new entity known as PL Asset Management. PL Asset Management is a standalone entity focusing towards the wealth creation for all our investors across the globe. At the same time, I would also like to bring to your notice that the team at front, that's funds management team, the team at the back office, that's an operational, admin, client service team remains the same. Only thing is that we have dedicated this business to a standalone entity, and that standalone entity, which is PL Asset Management, will be responsible for managing the wealth. We'll have lots of offerings coming very soon from PL Asset Management. As you all know, that the business of the PL Asset Management is headed by me, and the entire strategy, investments, and the quantitative strategies are headed by my colleague Siddharth Vora, who will be taking to you all through the quantitative strategies today during the call. At the same time, I'm also happy to announce that we have migrated our back office or complete client interface systems to a well-developed well spectrum. Next week, every one of you will be getting the link for the well spectrum and the new user IDs and the password. This is one of the best industry used back end software where it's not only the tablet but mobile, tablet, and a laptop as well as a desktop friendly. Very exhaustive, detailed information about processes, systems, and what kind of reports client can interact will be available. So all our partners and our investors will get the login probably next week from my team, and it will be migrated to the new software. We've already completed the migration process. We are just in a testing phase, and probably I believe today my team must have completed that. So Monday or Tuesday, every one of you will receive a detailed email about how our new platform works. We'll also be conducting the webinar on a newer platform with an exhaustive list of reports that will be available to our investors. And along with that, we'll also be sending you lots of other information about how those login and the softwares and the other aspects work. Partners will also have a very detailed reports available in this new logins. So please feel free. So there are two major changes at the asset management business. One, the asset management business is now in a standalone entity known as PL Asset Management. That will be truly focusing on the wealth creation for our investors in decades to come. And at the same time, we have also upgraded our backend systems and the processes. And for that, you must have received an emails and a lot of queries. So I thought that probably let me address that as well, that your power of attorney has been changed, because when you change the entity, the power of attorney along with the entity also changes. So that was related to the operational aspects. Friends, coming to the today's topic, probably the markets have been extremely volatile in last 3.5 months or so. All of us have seen that there was an excellent growth in last probably 18 to 16 months, where the markets have done fairly good and the strategies have made phenomenal well for the investors. For our early investors, every one of you will know that the AQUA had generated close to around 72 to 75% of returns in the first 12 months of the completion. Post that, we markets have been in corrective phase. We are also in a corrective phase. We have fallen as equal to the market or probably more or less in line with the market. So our entire thesis of building a quantitative strategies was proven right, that in a trending market we'll have a twice or probably 2.5 times alpha to the benchmark. In a falling market, we'll fall in line with the benchmark. How our strategies have done, what our processes have done, and how the investors have made money for or investors' portfolios have been constructed. Probably during the call, Siddharth will definitely take those questions for every one of you all. If you have any questions, you all can type in a chat board and probably will be more than happy to take your questions one by one post the Siddharth's presentation. We look forward for your continuous support, and this is the best time, trust me, to top up your accounts, because markets have corrected by 10 or 11%, but what is very important, that the sectors and the stocks have corrected by 25 or 30%. So the same securities, the same companies, same businesses are available at a very reasonable valuations. And data also suggests that whenever an investor who has done a top up in a falling market, their returns are far better than the investors, or a regular top up rather, I would say, in a falling market, are far better than the investors, those who have done a lump sum or a one time investment. With this, I'll hand over to Siddharth, who will take you all through the strategies, what we have done in last 18 months, how our strategies have performed, what you should expect in next 3 years from AQUA as a strategy. And trust me, this is a time that every one of you would start allocating your capital towards a quantitative based strategies, because that's where the great money will be made in years to come. Over to you, Siddharth.
So thank you everyone. Thank you so much, Nupur Bhai, for giving all our investors, brief overview on everything that's been going on at PL. And I also thank, so many of you all to take out your time and join today's call. We scheduled it at this time on a Saturday so that it's a little more convenient for our international investors to, engage with us and interact with us. I'll start by, just talking about where we are, what we're making of the markets right now, what we're making of the macros, how is the portfolio tuned, what are the current rebalances that are, going on. I'll just give you guys a broadish overview. I hope my screen is visible.
Yes, it is, Siddharth. Please continue.
Okay, perfect. Uh, yeah, so I think I've created this, one simple page to, make sense of everything that's going on in the markets right now. I think those who are not residing in India but are probably tracking Indian markets, they know a couple of big themes or the couple of key topics that are worthy of a debate or discussion, which is putting pressure on Indian markets in the short term. Starting with, some moderation in the pace of economic growth, a slowdown, a mid-cycle slowdown in the earnings growth of corporate India, rich valuations compared to its history and compared to some of the other emerging markets. Amidst all of this, we are also seeing rising US bond yields, a very strong dollar index, which is moving capital back from emerging markets into developed markets, with Trump coming in, creating the whole pro-America protectionist stance with, his likely tariff policies, his tax stance on taxation, which might be inflationary, keeping bond yields slightly elevated for the near term. We're seeing record foreign investor outflows from India. I think very important to understand that all these cues are negative. All these cues have been factored in for the last 3 to 4 months. And I think when we look at more data, we'll try to make some sense of why we're probably hitting a cyclical bottom of a certain sort, and the market is now ripe for a recovery and a relief rally. The legs and strength of the relief rally will be defined by how the earnings season progresses, by some of the key policy announcements in the budget, and some of the policies that Trump, comes to shore with. So we need to understand that, yes, over the last 3, 4 months, the news flow overall has been negative, whether it's commodity prices, inflation, monetary updates, macro slowdown, PMI numbers, geopolitical stress. Lot of things are going wrong. And the good part is markets have started factoring most of it in the price. When I talk about, headline valuations at a Nifty level, I think we're not even at a premium anymore. We are trading at a discount to historical averages. I'll showcase that data as well as we go along. We're actually trading at a discount to historical multiples. And therefore, from a headline perspective, valuations have calmed down significantly. In the mid and small cap space, there are some areas where there is some froth, but there are a lot of other areas where value has started emerging once again. So effective sector rotation is going to be useful to navigate the next couple of months, as we see that domestic investors will start coming in as strong value buyers in a lot of mid and small cap segments in India. Over the last couple of months, we've also seen markets becoming significantly narrower. The overall breadth has reduced. And again, when I show you cyclical charts, we'll understand that we are hitting sort of an oversold market zone where the chances of a recovery or a relief rally seem to be significantly high. Even when I talk about, all the broader tensions that, okay, the currency is depreciating. Will the currency be able to make a comeback? Will the Indian markets be able to make a comeback? Is the economy entering a long-term slowdown cycle? I think all of these issues can be put to rest. Every economic cycle, market cycle, which is structural in nature, does experience what we call a mid-cycle blip. Usually, it's a combination of forces that as we enter a strong growth phase, we see volume growth, we see cost optimization, we see margin improvement, and the base starts becoming very high. As we come out of this high base period, we see that most cost optimization measures have already played out, and therefore there is limited room for margins to expand. In anticipation of a very strong volume growth, we also see multiples expand significantly. Usually, when this happens, we call it a mid cycle peak. After this, we see a zone where either with time correction or with price correction or a bit of both, markets come back to more reasonable, palatable levels. This is the current phenomena that we are experiencing in Indian markets right now. So while the last couple of months might have been a little stressful, and for the next 20-25 days might be a little choppy because there are very large scale events happening around the world and in India, whether it's the earnings season, whether it's Trump, or whether it's the Indian budget. So all of these things will of course keep the markets excited, choppy, volatile. Some sectors will see circuit up openings, some sectors or stocks will see circuit down openings. So we got to be prepared for the next 20 days to be whipsawed a little bit by the incremental news flow and information. Having said all of this, I'll also highlight some of the key interesting or positive things that are happening in India. I think the rural part of the economy has been recovering very strongly, whether it's volumes, whether it's agri income or agri output. Overall, the rural side of India is doing well. The capital markets, the capital market participation in India, despite the volatility, despite the little 10-12% correction, has been holding up very strong. We continue to make record highs month on month in terms of our SIP books. We continue to grow significantly month on month, year on year, in terms of the equity mutual fund AUM and in terms of the number of demat accounts, SIP accounts, all of that. So the domestic liquidity factor has been very supportive. And despite the record FII selling, we've only seen a 10-12% cut at the index level. Of course, stocks, portfolios, sectorally corrections would have been very deep as well. But I think indexes have fallen roughly 10-12%. In earlier cycles, we've seen a 20, 25, 30% correction with half the amount of FII selling that we see as today. So the domestic liquidity factor has been holding and providing a lot of resilience to the Indian markets. The monsoons have also been good, and therefore we expect that the rural side of the economy should come back on track. The latest inflation numbers released 5 days back were also showing that inflation is likely to peak out in the near term, especially food inflation. So overall, I think while a lot of bad news has been in the price, incremental news flow is likely to be good, whether I talk about inflation, whether I talk about rural demand, whether I talk about SIP and domestic liquidity numbers, and whether I talk about valuations also, where most of the sectors are coming off the frothy levels. So new opportunities will be created, and hopefully, without expecting too much, I do expect that the budget will also not spoil the party too much for Indian investors and foreign investors. With that, broad context, let's, look at a little data to see what the data is also telling us at the same. This is just a heat map of the world where we see a lot of geopolitical stress. I thought this was interesting to highlight that the world has changed drastically in two aspects. One is the onslaught of wars and how wars are normalized. And second is the onslaught of viruses. Every couple of months, we have new variants, new ideas, new concepts of viruses being exported all around the world from our dear friend China. And again, we've been experiencing something called HMBV. It's a new one, but I think India has been quite resilient to it so far. Doesn't seem to be so fatal. But in the broader sort of context of viruses and wars, I think structurally the defense sector and the healthcare sector will also start to benefit from this. And I think healthcare has done well for the last couple of months. It's been a key part of our portfolio. We've been overweight healthcare. We've been out of defense since June 24, and now we see that value has started emerging once again within the whole defense and industrial segments as well. Hopefully, in the next couple of weeks, we might make some positions in the defense sector. So these are some sectors where we believe value has emerged, structural demand trends have started creating. If I also look at what's the impact of DXY, I think very important from a foreign investor perspective. We've seen that DXY and Indian markets and DXY and foreign flows have a very inverse sort of relationship. And I think this data captures it very well. If you look at the last 5 years, we've seen very clearly that every time DXY has been on a downward trajectory, foreign flows have started rising. DXY has been on an upward trajectory, foreign flows have started depleting from India. And I think this trend is likely to continue in the near future, given that the strength of the dollar determines how attractive on a relative basis emerging markets appear to be. Even if I look at Nifty returns, I think similar sort of pictures being painted. The Nifty returns also paint a similar sort of picture where we see on one hand, DXY rising substantially in the period from April 21 to October 22, and Nifty has been on a downward trajectory. Overall, we've seen that DXY levels had come off and had stabilized. Nifty returns are also sort of stabilized. And now that DXY is on the rise again, we see Nifty returns cooling off. So I think this is a key sort of indicator to track, and this might even help you guys plan your top-ups in a better way. As you start seeing DXY trends reversing, it's probably a great time to add into your Indian portfolios because you will see a strong bounce back in emerging markets, specifically India. Even if you look at India from a macro perspective and a valuation perspective, couple of things, we see that yes, Indian inflation has been higher, but we are seeing a slight cool off here. Even GDP growth tells you one thing very strongly, that over the last 3 years, India has consistently been the fastest growing large sized emerging market economy. So when you see that Indian markets are experiencing a slight moderation in growth, we can accept it simply because we've always maintained a very high track record of growth compared to other EMs. Even though our growth premium is narrowing in the near term, we are likely to make a strong comeback as we come out of this mid-cycle blip. And from a valuation perspective also, we have always traded more richly, more expensively than all other emerging markets. Whether you look at a PE basis, whether you look at a PB basis, India has been an expensive market. India has been the fastest growing market, and it's likely to continue to do so for the next decade or so. China has already had its growth spurt over the last 2.5 decades, and India is just in the beginning. It's in the middle of the 3 4 year cycle of its growth spurt, which is likely to last a decade or two. So I think use these corrections, use these slowdowns in order to build and ramp up your India portfolios without worrying too much about the next couple of months. What we see in the markets has a lot to do with the key macro cues. As I explained, fast growth, high base, moderation in growth, not slowdown, not degrowth, just a moderation in the pace of economic growth. Similarly, sort of stagnation in PMI levels. CPI continues to be a pain point for India, but I think the latest January numbers show that there is some relief on that front as well. When I talk about FI activity, I will show you guys a very, very interesting perspective. Let me skip a couple of slides and go there first. Yes, I think this slide paints a very interesting picture. We've simply done 6-month FII flows aggregated and Nifty performance for that period and how the cycle turns. So I think every major cycle that you see, we've seen strong FII outflows coincide with negative Nifty returns. Strong FII outflows coincide with negative Nifty returns. Again, strong FII outflows, negative Nifty returns. And this has played out multiple times. This cycle, though, is very, very different because we've already seen a phase of strong FII outflows, but we've seen like flattish sort of returns on the Nifty. And this is the point I was trying to highlight, that Indian markets have become resilient. Indian markets have a structural tailwind of domestic liquidity, and this is visible in the data. And the other interesting thing to observe here is that after a sustained period of selling, as the FIIs come back to India, we've always seen very, very sharp and strong rallies. Whether you look at the 13 to 15 cycle, whether you look at the 17 cycle, whether you look at the 21 cycle, we've seen that after a period of heavy selling, FIIs do in fact return to India to chase the growth or to find value. And therefore, as we see a bulk of FI selling already having been played out, we see a strong recovery in the near future. And I think some investors had questioned about a 10% drawdown, going to cash, becoming defensive, getting out of the market. This is just to highlight a very simple thing. In the last 18 years, India has envisaged 82 instances of more than 10% corrections. These corrections come, news gets digested, domestic sentiment, if good, people start coming to buy, and markets move on their original track of long-term growth of 12 to 15%. This has played out multiple times in the past 18 years, and this scenario seems no different. Unless there is a black swan event like GFC or COVID, we don't see this party stopping anytime in the near future. We don't see our data telling us that we are in for a 40% correction or 30% correction. Are we in for a 10-15% sort of correction? Yes, we've been. But for a 10-15% correction, our models do not prefer to go into cash and get out of the market and take the risk of timing the market. The moment you take a market timing risk and a cash call, again, getting back in swiftly without missing the recovery is a very, very complicated decision. We believe that when there is a global macro systemic risk likely to unfold and our data is able to capture it is when we go to cash. The last time we went into cash was in 2022. Since then, we've never gone into cash. Our cash model indicators have turned defensive, no doubt, but we are still a little away from a cash call. If the next couple of weeks give us more adverse data cues, we are likely to go into cash. But if not, we'll stay invested in equities. Uh, Another point, I was trying to make is that probably data tells us that we are at a cyclical bottom. All our technical indicators, from a quantitative perspective, do suggest that we are at a mid-cycle bottom and markets are likely to recover from here. Whether you look at stochastics of Nifty 50, mid cap, small cap, or 500, it looks like we are making a near-term bottom and there is a large scope of recovery from these levels. Even if you look at simple RSI indicators, again, it tells us that markets look to be oversold. Another important, point I was trying to make about breadth in Indian markets. I think the percentage of stocks that are outperforming has significantly narrowed down. I think except large cap, where more stocks are outperforming, not because these stocks are doing well, simply because the benchmark has only given a very low return. So it's easier to outperform a benchmark with very low returns. The mid and small cap and micro cap, which is where the breadth of the market is, I think 60% of stocks are underperforming the benchmark. Only 40% of stocks are outperforming the benchmark. And this is a point of concern. When we look at more cyclical data here, yeah, this also suggests that the breadth of the market has been narrowing very gradually. And it looks like we are heading towards the 40-45% mark where the market breadth likely reverses. We are almost there in terms of 6-month alpha, getting there in terms of 12-month alpha. So this period, the last 6 months, had to be challenging for Indian market simply because the breadth is narrowing every month. And in a narrow breadth environment, quantitative indicators try to play it defensive, try to hide behind quality, try to hide behind low volatility, try to protect capital and try to protect alpha without trying to gain too much on the upside. But as we get closer to the end of the risk off phase in the markets, our strategy is likely to shift gears and go back into an aggressive mode. Uh, to summarize what we've done, in the last sort of 18 months, one second. So what we've done in the last 18 months is first 12 months from June 23 to June 24, we played on the front foot. We were aggressive. Our models indicated that markets are healthy, sentiment is strong, momentum is strong, and we need to play on the front foot and score as much as we can. So in the first year, we delivered roughly 76% return, 2x of BSE 500, 3x of Nifty 50. After that, in June 24, our models signaled that quality and low volatility are the areas that we need to focus on. It's probably the near-term end of momentum playing out in Indian markets. The risk regime is shifted from a high risk or a risk on environment to a moderate to low risk or a risk off environment. And we need to be defensive. We need to protect our alpha, protect capital to the best of our abilities. So did we get the transition of the market cycle right? I think we did. We became very defensive. And when we became defensive, our model said that, okay, this is probably not the time to chase returns on the upside. We are better off protecting alpha on the downside. So let's look at how the numbers played out over the last couple of quarters for us. We've been live for roughly 7 quarters now. So I think quarter one, quarter two, quarter three, quarter four, which I call the bull market for AQUA and Indian markets. We played on the front foot. We beat BSE 500 and Nifty 50 by a very healthy margin in all these 4 quarters. Quarter five, we were up 7.8%, slightly underperforming the benchmark indices. Quarter six has been the pain point for AQUA, where we were down roughly 6.25% despite being defensive, and the markets were down roughly 2.5 to 3.5%. So this was one quarter where we lagged the benchmark, and this was because we became defensive by going into sectors which were ideally considered defensive, like consumer, staples, durables, all of this, IT and pharma. IT and pharma did well for us, but the consumer pack hit us damn bad because the urban side of India, the urban demand started weakening, and some of these stocks gave very high drawdowns. So I think that call of ours to go into the consumer sector didn't play out the way we intended it to, and therefore we suffered. Come back to quarter seven, we're down 1.4%, significantly better than the benchmark at 3.7 and 3.6%. So I think in a period of 7 quarters, we've had four stellar quarters, one decent to good quarter, one good quarter on the downside, and one horrible quarter. So I think it's not a very bad outcome. It's quite an impressive outcome overall to have four winning quarters, one okay quarter, and one bad quarter. And if you look at a more longer term data till 31st December, June to June, we've been down in line with markets. Markets have been down 2%. We've also been down 2%. So I think the way I look at the strategy is in a bull market, we do very well. In sideways markets, we would probably be in line. But in a bear market, again, we would shift gears and become extremely defensive by going into cash, like we've gone in previous bear markets. And let me clarify, a bear market is one which has more than 20% correction. So right now, we are in a market where we're seeing weakening breadth, volatility, choppiness, but we have not entered a bear market yet. Our correction on headline indices is roughly 12 to 13%, and it's not in the bear market territory as yet. A couple of other, interesting points that I would like to highlight. Just give me a second. Yeah, so on a calendar year basis also, when we look at our data, for the 6 months that we were live in calendar year 2023, we've done roughly 45% versus benchmark at 22%. For calendar year 2024 as well, we've done 18.69% versus benchmark at 15.8%. So for these 2 years, we've managed to generate alpha for investors. Of course, different investors could have different returns based on when they entered the strategy. We've had some phenomenal months, some not so great months, again a strong recovery month. So I think investors who stayed the course with us since inception have generated roughly 43% odd returns versus benchmark at 25. So it's a healthy alpha of 17-18% for those investors who started with us from the beginning. For those investors who would have come probably when the market shifted gears or turned, could have experienced slightly better or worse returns in the near term. A couple of other points that I would like to highlight about AQUA. I think this is a very, very interesting chart, and this is basically analyzing the alpha, the rolling alpha of AQUA strategy on every 6-month basis. So what we've done here is we look at how the strategy is performing versus the benchmark on a 6-monthly period to see which are the major inflection points that we've had. So I think in 2008, 11, 12, 19, 20, we've experienced this sort of a phase where our alpha on a 6-month basis has been collapsing. But every time our alpha collapses to these levels as marked in these boxes, we see a very, very sharp recovery in alpha. So I think if you look at the 19 cycle, we've bounced back with a 40% alpha over the next 6 months. If you look at the 2012 cycle, again, we've bounced back with a 30% alpha over the next 6 months. So I think when I look at this data from a cyclical perspective of the strategy itself, 6-month basis, 9-month basis, 1-year basis, this data indicates that we are likely to sort of trough out in terms of where our alpha is versus benchmark. And from here on, we're likely to experience a strong recovery in strategy alphas. So a good time to consider, topping up, using this correction, using this negative alpha phase to build onto your portfolio. Another interesting thing that we would like to sort of highlight here is how we've seen multiple corrections and recovery in Indian markets and how factors have actually performed. Essentially, we are a factor based strategy. So we need to evaluate how factors do during these different phases. So, one thing that is evident here is that in every recovery, momentum, high beta, value, these are some of the sectors that are likely to do very well. Right now, our portfolio is positioned to quality, low volatility, dividend, which are what we call the defensive sort of factors. And the reason for the defensive factor construction is every time we see a peak to trough scenario in markets, we understand that defensive factors help you a little bit on the drawdowns. And I think look at the performance of momentum, high beta, and value in drawdown cycles. Versus that, look at the performance of quality, low volatility, and dividend and drawdown cycles. Two things are evident here. One, all of them fall. The other thing is defensive factors fall a little less. So right now we are in that phase that we've been defensive for 6 months and now we are shifting gears to become aggressive once again. So as we go along, we do expect a tilt towards slightly high beta sectors, slightly high beta stocks, momentum focused factors, and value focused factors. So this data helps you to understand quantitatively how we try to navigate these models, how we try to navigate these markets. Of course, despite all the data, you could get a call wrong where we've turned defensive. We've gone into defensive factors based on historical correlations. But at this point of time, the correlations might not play out. And therefore, we say that in the world of quant, if you have an accuracy rate of more than 50% in the 50 to 60% range, you're going to eventually hit a very good sustainable alpha. And that's what we try to do. I think all our investor meets, we've highlighted that monthly alpha 60 to 65%, quarterly alpha 70 to 75%, yearly alpha roughly 85%. This is the way we try to create alpha. Of course, when we say we get it right 60 65% of the time, we get it wrong 30 35% of the times as well. And I think one quarter is when we got it kind of wrong, but hopefully the strategy gets back on track from here onwards and investors experience the same sort of returns that they experienced in the first 12 months 14 months of the strategy.
Hi, Siddharth. Thanks. You have taken it probably well.
Yeah.
Any other key points that you would like to highlight to the investors? One more thing that in between, I would like to just budge in and say that, as Siddhartha said, that we also have a global platform for investors looking for the similar product during the dollar denomination product. That means the PL AQUA product is now available in dollar denomination. You can reach out to me or you can reach out to your relationship managers who can help you to invest in Indian market by investing in dollar terms. So your investments will come in dollar terms, your redemptions will happen in dollar terms. So the entire currency fluctuation, the taxation will be taken care by our team and our strategy. So that was one very important point. I thought that let me just put forward in front of everyone so that you all know that now, as an NRI and overseas investors, you do have a dollar option also available with Prabhudas Leela. Thank you.
Again, another interesting data point that we would like to highlight. So more than 70% of small cap stocks have corrected by more than 20%. I think this data tells you the quantum of this sort of correction that we faced. I think we have closed our peak to trough at roughly 12.5%, which is significantly better than most drawdowns that you would see in concentrated portfolios. Uh, Uh, Another thing, one second, just finding a certain data. Nupurba, if there's anything else you want to, clarify in the meanwhile, I'm just finding a couple of relevant slides that I want to, highlight.
No, no, nothing. I have just touched base about the operational aspects. I've also touched base. Probably, I think so they've understood. See what the point that Siddharth was trying to make, and we also want every one of you all to know is that whenever you invest in Indian markets, India market typically has been a long only market. So in a long only market and a trending market, don't look at the short term 3 months, 6 months return. Look at the overall period. Look at the period that end of 3 years, 5 years. Are you able to generate the alpha? We are confident that 3 to 5 years you will generate much better alpha than the benchmark. That is very, very important for every investors to know. And for that purpose only, our the entire endeavor was to make you understand that please look at the India as one of the fastest emerging global market, and even the world data suggests that there's no better market than India for the investment perspective. Thank you. Siddharth, over to you.
Yeah. So again, as I was saying, that June was where our strategy completely shifted gears. I would request investors to look at this in a certain context. The context I'm trying to build here is the concept of adaptability. Whether we got it right or wrong is a second sort of story. But June 23 to June 24, if you look at the portfolio beta, it was consistently higher than 1. June 23, the strategy made a very sharp strategic shift to go into low beta. And I think this shows that our strategy was able to capture the broad trend of peaking out phenomena in the market and understand that we need to be defensive. Now, what didn't work here is that despite being defensive, as I said, 70-80% of the stocks have all corrected. So, irrespective of which stocks you're positioned in, all you can do is fall less than the market rather than not fall at all. And I think December month, everybody would have seen our data till 31st December. We were up 0.7, 0.8% in a month where the markets were down 3%. So I think on the downside, we were able to manage the portfolio well. January has been a little rough, but we expect a nice recovery from here on. So hopefully our positioning and rebalancing should help us ride the recovery well. I think I'll take a couple of questions, before I share a couple of other slides.
Hi, participants. If you have any question, please type it in a chat, probably chat board or probably in a question and answer. And Siddharth and I will be happy to take your questions. Probably we have covered majority of points. We have covered all your doubts. We are also open on one-on-one conversation in case if you have any specific points to be discussed. But we'll wait for 2 to 3 minutes for every one of you all to type your message. Thank you.
Yeah, I think this is a very interesting thing I want to share with all our investors, that how India did in 24, what we call and what everybody's calling it a tale of two halves, right? Our portfolio was positioned in momentum and value for the first half of 24, literally till 30th June. Momentum and value did 34 and 30%, and defensive factors like quality and low vol did 12, 14%. They underperformed benchmark at 16%. Coming to the second half of 24, again, very interesting data. Momentum and value corrected the most, significantly higher than Nifty 500. In this period, it's not like quality or low vol gave significant returns. They actually didn't give any upside, but they relatively outperformed. So this is literally what we experienced in our portfolio as well. That when we were, tilted towards momentum and value, we made a lot of money. As we moved to quality and low vol, we didn't lose too much, but we didn't make too much either. But the point to understand here is that had we not switched, had we continued to be in momentum and value, even for the second half of 2024, we would have seen a significant capital erosion. We closed the 6 month period with a 2% or 1.8% drawdown. We would have probably closed that with a 9-10% sort of drawdown. And that is something which we avoided by our strategic shift into defensive factors. And I think this is a very important aspect of the strategy to understand that when we say we are adaptive, we are truly adaptive. Sometimes our adaptive portfolio catches the right part of the cycle, sometimes it doesn't, but over a 3 year, 5 year, 10 year cycle, this strategy, this approach of changing gears in line with market conditions has proven to generate significant alpha for investors over long term cycles.
Siddharth, let's take few questions. Probably we
Yeah,
have a
so
question on a
uh,
chat board.
somebody uh,
Yeah,
somebody's
feel
asked if our investment being NRI, our return can still take care of inflation and rupee depreciation. So I think inflation definitely, I would say, because AQUA over 5 year, 10 year, 15 year historic tests suggest that if Indian markets have compounded at 12 to 14%, AQUA has compounded comfortably north of 25% over any long-term cycle. So inflation at max, you can expect it to be in the 5 to 8% range. So I think beating inflation is a given over a cycle. Of course, if you look at a peak to trough scenario and you'll be like, oh, my portfolio is down 12%, inflation is at 8%. So for a 3 month period, how did AQUA beat inflation? Of course, you're not supposed to look at equity returns like that. But over any sizable amount of time, you will see AQUA beating inflation. In terms of the currency depreciation, I think the policy of the new RBI governor is to avoid a lot of volatility in currency movement, but at the same time, let free market forces sort of dictate where the currency stabilizes. I think we've lost a good 5-7% over the last couple of months in terms of currency depreciation. But again, we've seen structurally, if India is able to gain export share in terms of services and manufacturing, if crude oil prices stabilize with the geopolitical stress around the world reducing, then our import bill will also reduce and currency should find some sort of stability from here. Again, if you look at 3 year cycles of currency depreciation, we've pretty much hit a cyclical high in terms of how much a currency can depreciate in any 3 year cycle. So hopefully, incrementally, we don't see currency depreciation to play out the way it did. And therefore, that should cushion some concern over the next 12 to 24 months.
very interesting question from Mr. Amir Appu, and I would like to address that. Probably your concerns about FII versus domestic investors. Please, this is a data, and it's proven in last more than 2 years that now India has become Atmanirbhar when it comes to the investments in a capital market. So India of its own, with the power of not only retail but ultra HNI, family offices, the equity cult towards India. India had a very limited exposure to the equity. Now the equity exposure in India for investors across different states of India are growing. So with this growing appetite of Indian investors to participate in capital market, it is very, very important that the India is self-reliant and Atmanirbhar. So now FII flows, as Siddharth has put up in one of the chart, that will not matter much. Even if the FIs are selling, Indian markets will continue to rise, continue to outperform because the India is moving from a physical assets to a financial assets. This is a very important transition. We all have seen this transition in a developed or a developing markets, and India is exactly in the same phase where we are moving from a physical assets to a financial assets. And when this transformation happens, you'll see the consistent inflow. So do we need FI? We definitely need FI. But without FI, can Indian market sustain? Indian market will definitely sustain far better than even an FI inflow as well. And the data has suggested in last 2.5, 3 years that we have done far better despite of FI selling into an Indian market. Till corporates are doing good, till earnings are at all-time high, we don't see any fear that why you should not look at Indian market.
I think nothing else from our side. It was just the agenda of this call was to give you guys our take. What are we making of the markets, the macros, portfolio? How are we positioned right now, and how do we see the markets and portfolio evolving as we go ahead? Happy to answer any doubts, queries. You guys can send in an email, WhatsApp. Our teams are there. All your RMs are there to take care of all your queries. And be rest assured that in this journey, long-term journey of wealth creation, we will have good times, we'll have bad times, we'll have horrible times, but we'll stay connected, we'll stay engaged, and we'll work day and night to try and make sure that we're doing the best we can for your capital.
Thank you everyone for
Thank you
participating.
guys, thank you so
Really
much.
appreciate your time. We have a dollar fund available. The purpose of keeping the call at this hour for an overseas investor is please reach out to us for dollar fund. We'll take care of everything, and we are always available whenever you need for any kind of guidance. India is one of the fastest growing market globally, even by World Bank data as well. So please be part of this market. Structurally, India has been a bull market. It will always remain a bull market. So for that, we look forward for your commitments. We are always there to support you. As I've already said, with our new interface, you'll have a far better experience in terms of the valuations, reports, and host of other facilities. For overseas investors in US and Canada specifically, my team will be sending you all a detailed Jan to December returns and tax reports probably in next 5 working days. If on or before next Friday, you'll have that in your email. If you want any additional information, please do reach out to us. Thank you everyone for participating, and we really appreciate that. Any other question that you would like to take, Siddharth?
No, I'm good.
Thank you, guys. Thank you. Thank you very much for your time and patience. Thank you.